Is the current banking crisis over?
Yeah. First, I want to say all the bank CEOs did it. So I may have been the first phone call, but everyone was on every call talking about ideas and what works, and they're all patriots and want to help. This is not 2008. Okay, this is much more limited. There are only a handful of banks that had this particular problem. They'll eventually be resolved one way or another, and I think then people should take a deep breath. In a week or two, a lot of these banks can be reporting earnings. I think they'll probably be pretty good.
A few moments later.
Overall deposits at the end of this last quarter, as of March 31st, were $104 billion. That represents a almost 41% decline in deposits over the $176 billion that we saw at the end of December of last year. That $104 billion was also below the analyst estimates calling for roughly $145 billion as of this past quarter end. It's also important to note that $104 billion they report factors in the $30-some billion that was put in by the consortium of large U.S. banks to help shore up the deposit base at First Republic. We've also got some other headlines coming through with regard to future policies. We will see job cuts, unfortunately, at First Republic Bank, who say that they will cut, in this current quarter, between 20 to 25% of the workforce at First Republic.
And I'm hoping it will resolve, rather shortly.
You're hoping.
But hoping.
But is the crisis over? You wrote in your letter there will be repercussions for years to come.
Well, that's different. I think those repercussions are regulatory. I acknowledge, obviously we have a problem, things need to change, but I'm begging the regulators, just take a deep breath. There are hundreds of rules. You have to be very careful. What do you want in the banking system?
Do you expect more banks to fail this year?
I don't know, but if there are, honestly, they'll be resolved and it'll probably be the last of them.
A lot of news this week. Breaking news overnight. Another American bank has failed.
Oh, no.
Just this morning, financial regulators in California seized First Republic Bank after it lost $100 billion in deposits just in March. It marks the second largest bank to fail in American history. The Fed struck a deal to sell most of the bank's operations to JPMorgan Chase.
In the aftermath of the great financial crisis, we said never again we're going to allow this to happen. And guess what? It is happening again. It seems that every crisis we have, JPMorgan ends up being the winner. And today we got the news that First Republic Bank has been seized by the FDIC, and it has been sold to JPMorgan Chase. Now, the bank has a lot of trouble, a lot of problems, and the price was at around $60 billion. And I thought, hey, JPMorgan paying $60 billion, I don't think it's going to happen. It's a diseased bank for $60 billion. But what if I told you that JPMorgan got FRC pretty much practically for free? We know that FRC lost about 40% of its deposits. We're talking about tens of billions of dollars. A lot of these billions of dollars ended up in JPMorgan Chase. And JPMorgan used some of these tens of billions of dollars that they got from FRC to buy FRC at a bargain. It's evil genius, especially if we find out that JPMorgan is behind the bank run. But that's just a tinfoil hat theory for now. The other thing is, it seems that every time we have an FOMC meeting with an important interest rate decision, we get a bank failure. As if to say, hey, Jerome Powell, look at what's going on. Would you like to raise rates even more? And of course, we all know that JP is a weak man. He's indecisive. He fails and falls under pressure, right? But hold that thought for a minute, because JP is squished in a vice. One end being the bank failures, the other end being inflation not cooling down. We'll talk about that in a minute, but the headline reads, U.S. regulators seize First Republic Bank and sell substantially all assets to JPMorgan in the largest bank failure since the '08 crisis. The fall of the $233 billion First Republic Bank, and keep this number in mind, $233 billion, is larger than both Silicon Valley Bank and Signature Bank, which were the second and third largest bank failures in U.S. history at the time of their undoing roughly 7 weeks ago. Seattle's Washington Mutual, a lot of you remember that one, which went under with $307 billion in assets in September '08, was still bigger. You can see it right here. Sure, WM was the largest bank failure in U.S. history, but we have the three largest ones right after WM happening at the same year. In 23, we have First Republic, Silicon Valley, and Signature banks blowing up with assets exceeding $500 billion. But somehow, this is a bull market. Somehow, we're not going to head into a recession. Somehow, everything is okay. Anyhow, JPMorgan, the nation's largest bank, agreed to assume $173 billion in assets, $30 billion in securities, and $92 billion in deposits. And they say assumed. JPMorgan assumes. No. JPMorgan was handed all of these assets. $173 billion, $30 billion in securities, and $92 billion in deposits. But wait, that's not even enough. The FDIC sweetened the deal by agreeing to share losses on certain residential and commercial loans, giving JPMorgan some protection if the assets go bad. This is the most important part, folks. Number one, we gave JPMorgan over $100 billion in assets for free. And we sweetened the deal on top of that by saying, hey, if you get any of these bad assets, we will assume the responsibility. It's a no-brainer. You wonder why JPMorgan stock was up by about 4% in the morning today? And I know what you're going to say, but Maverick, this is the FDIC. This is not we, the taxpayer. Oh, really? The FDIC estimates that First Republic Bank failure will cost it $13 billion on top of more than $22 billion. From the two other failures in March, we're talking about SVB and Signature banks. This is the funniest part. Taxpayer money does not support the fund. Instead, the FDIC recoups its costs with an assessment paid by banks. If that's true, then why don't the FDIC just print money out of thin air and pay for all of our tax revenue? No more taxes, dear Americans. The FDIC will take care of it all. We have a debt ceiling now. Janet Yellen says June 1st. We're done. We're out of cash. How come the FDIC doesn't just fund the government? I'll tell you why. Because banks rob, that's the key word, rob, from us, overdraft fees, bullshit fees, our deposits. And they use that cash to pay the FDIC, which is a branch of the federal government, by the way, which we fund. And nothing is for free, folks. What goes around comes around. We are going to pay for all of this. As part of the First Republic Bank agreement, JPMorgan will make a cash payment of $10.6 billion to the FDIC. And listen to this. And the FDIC will also provide the bank with $50 billion in loans. Come on, man. They pay $10.6 billion. They get over $100 billion of FRC's assets. And on top of that, the FDIC sweetened the deal by saying, hey, any failures in these assets we'll take care of. And oh, by the way, here's an extra $50 billion. If this doesn't seem obvious to you, I don't know what will. The FDIC is owned by JPMorgan Chase. And what happened here, all of this is money laundering. You give me $10 billion, I give you $50 billion back. You give me $10 billion, I give you $100 billion back. And we're just going to pretend that this is a rescue operation and JPMorgan saved America. Anyways, JPMorgan said it will recognize a one-time post-tax gain of roughly about $2.6 billion. It anticipates $2 billion in post-tax restructuring costs over the next 18 months. Yeah, sure. The deal to buy First Republic Bank places CEO Jamie Dimon at the center of a national banking crisis for the second time in 15 years. And further solidifies his status as a rescuer of weaker institutions. What the f*** are you talking about? He's a predator. He's not a rescuer. He sees these banks under distress, and then he goes to the government and say, okay, I'll bail you guys out so you don't get in trouble with the voters, but you're going to hand me all of these deals, give me all of these assets for pennies in the dollar, and sweeten the deal with loans and protections by the FDIC. It is a criminal organization, folks. Our government invited us and others to step up, and we did, Demon said in a statement. In 2008, Demon acted twice to help stabilize the financial system. How did that work out? JPMorgan Chase purchased New York investment bank Bear Stearns in March of that year, getting a $29 billion backstop from the federal government, and then Seattle's Washington Mutual in September of 2008. But of course, they're not going to blame the incompetency of the Federal Reserve, the bad management and wacky decisions by SVB's management, FRC's management. They're not going to blame the predatory behavior by JPMorgan Chase. Blame it all on the shorts. Short sellers also applied more pressure. Those with bets against FRC have earned $1.37 billion year to date on a mark-to-market basis. It is the most profitable short position among stocks thus far in 23. By Friday, First Republic stock had dropped to $3.50, down 97% for the year. The bank's market value, once $40 billion, was just $640 million. And the big question now becomes, what will the Fed do? They got blackmailed with the SVB last time around. Now we have another blackmail with FRC. And Nick Timiraos, the Fed whisperer, so-called, he says until now the Fed has been looking for clear signs of a slowdown in easing inflation to justify a pause. But after this week, the calculations could flip. Officials could need to see signs of stronger than expected demand and inflation to keep hiking. Now, this might sound like a riddle to you, but what he's saying is the Fed is leaning more dovish now. The Fed is more likely to pause after doing one rate hike because of the blackmail by SVB and FRC's collapses. Here's the problem. Liz Young says ISM manufacturing improved a touch in April to 47.1, but still in contraction territory. Here's the problem. Prices paid, not in this chart, came in at 53.2, above the estimate of 49, and last month reading 49.2. Treasury yield moved up. Message is higher inflation plus weak growth equals, say it with me, stagflation. And here it is. Prices increasing from decreasing 53.2, the only positive reading in the ISM Manufacturing Index, with exception of customers' inventories, 51.3, and employment at 50.2, all inflationary. And here's the importance of ISM prices paid. It has a direct correlation with inflation. As you can see in blue, it went down, so did the CPI. But now prices paid are rebounding higher again. This could be a leading indicator that the CPI is about to rebound again. Ladies and gentlemen, we are at the cusp of perhaps the biggest and most disastrous Fed decision in history. If they double down and they say, okay, we're concerned about this inflation problem, more banks, more institutions, more companies will blow up. 100%. If they back off and they say, we had two banks just collapsed, we think we've done enough, we believe in the lag theory, Jerome Powell is now under the influence of these fools that infiltrated the Fed recently, like Goldsby from Chicago. Now the brain dead is gone. If the Fed backs off, there is a high possibility that inflation is going to rebound significantly higher. And it could, keyword could, make a new high. Believe it or not, because the conditions, the underlying conditions of inflation are still here. The aggregate demand in the economy, the unemployment rate's too low, and commodities inflation could spike significantly higher now that the dollar is actually down. And this could be disastrous for the economy. You know why? Because yields are actually paying less than inflation. So is the stock market. So is your salary. We're all losing to inflation. Now, what does that mean? It means that bond yields will have to catch up with inflation. They will have to pay you more than the inflation rate, which means if yields indeed spike significantly higher, above 4-5%, it's not just banks that will blow up because of deposits coming out and chasing all of these yields, higher yields, to keep up with inflation. For now, everybody's losing to this inflation rate, but money will come out of equities, significantly so, to chase yields higher. Would you like to stay in a stock market that is losing to inflation? Absolutely not. And here's yet another wrinkle that we got today. Janet Yellen came out today and said that June 1st will be the new debt limit deadline. The country is running out of cash. And the recent tax grab by the government was not enough. The Fed is in major trouble right now. Damned if you do, damned if you don't. And this lunacy in the stock market of, oh, I don't care about anything. I don't care about banks blowing up. I don't care about the recession. I don't care about Fed raising rates. I don't care about inflation. I don't care about anything. All I care about is AI. This kind of stupidity will stand naked against all of these looming threats. You have not seen anything yet.